The Hedgeless Horseman here is February 25th, 2025. I thought I would do a Copium video because it was requested. First of all, thanks to the sponsors. Looking at markets, gold is down a bit, silver is down a bit, copper is down a bit, oil is down a bit. Nasdaq is having some problems, and maybe more interestingly, crypto is definitely having problems. And wouldn't you know, this support line finally broke, and MicroStrategy is tanking, and you can tell on Michael Saylor's tweeting more than usual about, you should be buying the dip and all that. So it definitely seems like he's sweating a bit. I mean, I would too if I basically ran a pyramid scheme. I mean, that's what he's famous for. I mean, MicroStrategy is down 12% yesterday, and yeah, I mean, I don't know what people really expect. When the high priest is famous for basically, well, he did some accounting shenanigans as well as basically obviously not recognizing that the tech bubble was a bubble. I mean, if that's your main champion, yeah, if the poster child of the IT bubble in the early 2000s is your main champion in anything, I think it's, not impossible that you are in fact in a big bubble. Anyway, so some copium. I mean, we've seen, I think, first of all, that, or I hope that people who have, keep watching all these videos, or learning to not take the volatility personal, or more importantly, I've done quite a few copium tweets today. I mean, the main thing really is you can be abused, or you can abuse volatility, or use volatility. This very same reason why people hate this sector is the same reason why I love this sector. Simply comes down to volatility, irrational price movements in the short to medium and long term, or in the long term perspective, meaning that this sector goes too high and becomes overvalued at some points, making a major top, then it crashes and goes down too much, making a major low. I mean, unsustainably high to unsustainably low, or unsustainably cheap to unsustainably high, and back and forth and back and forth. And on a daily basis, you see the same type of action. I mean, it's absolutely ridiculous that, for example, today, I saw a Copper Explorer drop 10% in price. Copper is down 0.49%. Sure, thereafter copper and gold actually. It's like, does today's move in metals to the tune of 0.49% to 1.3% take away 10% of a company's entire long-term value? I mean, of course not. It's the most egregious thing ever. And somebody's obviously selling it down 10%. And if you own that stock, which I do, you can be very frustrated in the sense that, on paper you're getting punished. That position is worth 10% less today than it was yesterday. You have, paper losses relative to yesterday. You have 10% less. In the big scheme of things, does that really matter? no. I mean, an exploration story, if they fail to make any discoveries, it's going to go down and stay down. If they make a discovery, they're just going to go up even more. I mean, sentiment doesn't change geology, especially if it's a self-funded, or yeah, if it's a fully funded junior. It doesn't matter at all, really. So nothing actually changed. If they find something that might be in production in 10 years, totally irrelevant what gold did on February 25th, 2025, if that, whatever they might find, if they find anything, if that is in production by 2035. There is zero correlation between that, or causation. It doesn't matter. A mine in operation 10 years from now has no effect on its cash flow from what gold traded at on any given day 10 years before it was in operation. So again, you can look at it and be frustrated because you're getting, quote, punished, and you're like, oh, I mean, it doesn't make sense, it's not really rational, which it isn't. But that also means, by default, it's irrational selling. So assuming, I mean, given that the stores are intact, the geology didn't change, the price just got cheaper, meaning it's pricing in even less chance of a success. The only change really is, I mean, if a stock selling at $1, that's going to go to $5, for example, in 3 years. Let's say that's the case. If that sells off 10% and goes down to 90 cents, what actually happened? Nothing really. Yes, if you bought it the day before at $10, you're going to see a 10% loss, paper loss. It's still going to go to $5. So you can obviously, the way you get abused by volatility is if you sell the next day when it's down 10%, given that nothing else has happened and the value of the projects or company for sure did not go down 10%, meaning that it would be rational to be okay to sell it. The value didn't go to 90 cents. So if you get, again, abused by the volatility, it means you buy it one day, price for irrational sentiment reasons goes down 10% the next day, and you sell out at a minus 10% loss. So you take that paper loss and convert it to a real loss. You just shaved off 10% of your money in one day. Congratulations. Whereas if you had the ideas like nothing at all has changed, it doesn't change the news flow that's going to come. It doesn't change the chance of success. It just means that it's pricing in even less of a chance of success, meaning that in case of success, it's just going to go up even more from 90 cents than it would from $1. So you have then the option offered by Mr. Market to buy at 90 cents and get an even better risk reward, or sell something if you don't have money that, let's say, didn't go down 10% and pick up that extra opportunity. At face value, nothing changed. I mean, if you only had two stocks, one was down 10%, so your portfolio is down 5%, because let's say the other stock you owned was plus minus zero. So you're down 5% on paper. You sell some of the stock that didn't irrationally go down 10%. You buy some of the stock that has an intact story that went down 10%. Nothing at all changed in terms of the value of, the value of your portfolio on that very day. If you sell something to buy something else that has gone down, you're still down 5% on that day. Even if you took all the money in the stock that you could sell plus minus zero, because it traded neutral, and let's say there was enough liquidity that you can sell the entire position in the other stock plus minus zero. And you put everything in the stock that just went down 10% for no reason. Your portfolio is still down 5%. The thing obviously is that, and this is an extreme example because I'm just using two stocks in this case, the difference is that instead of that portfolio maybe going from $1 to $5 in the future, so you're looking at a 400% return, assuming the stores are absolutely intact and you could kind of know, which is impossible, but I mean, as a theoretical example, it makes it works. If you think that stock you just bought at 10% cheaper price, that you sold everything you had in the rest of the portfolio, meaning if you had a $10,000 portfolio, you sold 5,000 of the other stock that didn't go down and put it in the stock that went down 10%. If that stock is still, as the case is intact, it's going to go to $5 someday. Now you added $5,000 when it was at 90 cents. So it's going to go up more than 400% from that point. And that's going to mean it's going to go, that 10% discount is going to mean more than 10% future extra upside. So you actually created future money by using the irrational volatility. Versus, let's say, the person that bought it the day before and sold out at a 10% loss in an intact case. He just basically did the dumbest thing you could ever do. So he basically shaved off 10% in one day, which is an extremely costly compounding result, obviously. If you would shave off 10% every day, you would be at minus 99 in whatever, in a hurry, right? Same market, totally different. Same market, same options open to everyone. But one person actually used the volatility. He was proactive. He didn't predict it was going to go down 10%. He saw somebody dumb enough to sell it down 10%, and then he took advantage of that person. You don't want to be the guy that's being taken advantage of. You think, oh, it's down 10%, like it makes any sense. And then you, of course, think it's going to go even lower, because then you're going to be thinking, oh, you know, again, it's like people sell the lows because they think it's going to go lower tomorrow. Otherwise, they would have waited and sold tomorrow. That's basically every day, all day in this sector. People buy because they think it's going to go higher tomorrow, and people sell because they think it's going to go lower tomorrow. So you have like extremely irrational volatility on a daily basis, on a short-term basis, on a medium basis, and a long-term basis. There's opportunities flying around any single day. Some stocks out there, we don't know which, are going to trade at exactly what price in the future. But some with intact stories will for sure be up. So some of a one-day dip today might offer 40% extra returns in the next 3 years. That is absurd. That comes from 1 day's worth of volatility. A 3-year extra 40% return. That's like, you know, it would be pretty good to get that kind of return in 2 years. And this is just an added, let's say, 40%. It's absolutely insane how much just the daily irrational volatility in this sector, how much opportunity it creates. So if you take advantage of that, even though your portfolio, again, if you, let's say, value shuffle, at face value, your portfolio's value today will not change. Again, even if you had two stocks, one goes down 10%, the other one doesn't, you sell all the shares in the one that didn't go down by the one that went down 90% or 10%. If you didn't sell the one that was plus minus zero and bought the one that was 10% cheaper, your portfolio would still be, you know, you would be down 5%. If you did sell it and bought the cheaper company, your portfolio would still be down 5%. So at face value, you can't tell. Nothing has really changed because you just reshuffle, and that has no effect on today's portfolio value. Whereas it can be just that reshuffle on 1 day's worth of volatility, again, theoretically in this case, could bring much more than 10% extra, you know, returns in your portfolio over the next 3 years. So insane, no implication today. You can tell. Portfolio value didn't change. Your future portfolio value might change in a significant way. That's how you kind of, if you're proactive and smart about things and see volatility as something to use, not get abused by, you're creating future. You can create future money, added extra future returns any day that the market is volatile. And this shit happens not every day, but a lot of days. So let's look at I'm going to go through some, let's say, Copium posts. I mean, this is a very good example of what I'm talking about. If gold is down, 1.3%, okay? Let's say you have a gold producer. This says that compared to yesterday, gold price is today 1.20, let's say 1.3% lower compared to yesterday. That's all this metric here is showing. Relative to yesterday, gold could be at $10,000 or $1,000. This just says is 1.3% lower today. So when you think about it, if gold goes back up tomorrow and then stays flat for the rest of the year, it means that a mining company got, okay, now it's clawed back a bit, so let's say 1.3% low revenue today versus yesterday. And since it's, I mean, we're talking, again, in this example, we're pretending that gold, which, I mean, it might as well go up tomorrow. I have no idea. So let's say it takes back it goes up $39 tomorrow. So it was just a 1 day dip, peep. So it affected, and then we assume it stays flat, etc. So it affected, this daily dip affected 1/365th of a gold company's annual production. It's not that they got 1.3% lower revenues on their gold sold forever, for the rest of the year, not even tomorrow, just 1 day in this example. So imagine how little effect that has on a gold miner's long-term intrinsic value, that for 1 day and 1 day only, on 1/365th portion of their 1 year production, and they might be in operation for, let's say, 15 years, they got 1.3% lower revenue. So meaning that if you had a mining company that produced 365,000 ounces per year, on 1,000 of those ounces, they got 1.3% less paid, which is basically nothing. It's beyond a blip. Yet, like today, you can see some producers, for example, go down 5%, which suggests that 5%, assuming if we buy what Mr. Market is selling, it's suggesting that 5% of the entire long-term intrinsic value of the company, all the assets, all the potential growth, all the potential whatever, went down with by 5 whopping percent. So 1/20th of the entire value, long-term value of the company went down today by 5%. I mean, this is a good example of how insane even a day's worth of volatility really is. Because gold might as well go up tomorrow. Gold might as well keep going up. Gold might as well be at $4,000 in a year from now. The market does not know that. But the only thing we know that is that today we get paid, a gold producer gets paid 1.3% less than yesterday on 1 day's worth of production. How on earth can you draw the conclusion that's like, yep, that probably means that the, again, entire intrinsic long-term value, all the cash flow that's going to come over the next 15 years, all the potential discoveries, all the exploration assets, all of that is worth 5% less today. That is absolutely crazy. That makes absolutely no sense. There's no real causation correlation there, if you know what I mean. Because again, at face value, knowing that the future is unknowable, the only thing we know today is that today's gold production from a gold producer gets them 1.3% less if they produce the same amount of gold they did yesterday. That's the only thing we know today so far. And then of course gold might be up later today, and let's say it claws back everything, and let's say they sell their gold at the end of the day's pricing. In that case, nothing really changed. Gold might be green for all we know in an hour. Yet you could buy for a period of time maybe the entire asset base of a company for 5% less. I mean, it's just mind-numbing how, let's say, fucking stupid almost every single day's worth of volatilities. It's everything is irrational in a sense. Every daily swing, every weekly swing, every yearly swing, I was gonna say, can be like super irrational. Anytime you see this stuff, which is very, very often, Mr. Market is doing irrational price setting. So the more volatility there is, and Buffett himself has said that, he likes, or Peter Lynch, I think, they like volatility, because that means the market is making mistakes. The more volatile a sector, the more mistakes are happening, and the bigger the mistakes are. Berkshire Hathaway typically does not go down 5% in a day if nothing is changed. Imagine if you get a 5% discount for no reason on, let's say, Berkshire Hathaway 20 years ago. That extra 5%, how much of extra returns you would have gotten from that today? Who knows? Maybe, maybe hundreds of percent or something. It's just absolutely insane how just a day's worth of volatility, how profitable that can be if you use it, if you take advantage of it. Yes, paper losses inevitable and happens a lot. I don't predict when this irrational volatility is gonna hit. I can't predict what stock is gonna get hit the most or anything like that. That's inevitable and happens a lot. Letting dipshit Mr. Market beat us, that's basically unforgivable. And if you get Mr. Market to believe that he holds the truth, he's all-knowing, he knows something because an intact story got sold off. Because often you see, and I talked about this recently, you even see gold juniors, gold producers sell off because silver is down, not because gold is down. And they don't even have silver. They don't even produce silver. They're not even looking for silver. But silver's down 1.5%, they go down 5%. That's maybe the most absurd example, but that happens a lot. So my point is that, yes, you have a ton of people whining about that fact. Being victims of it in a sense, because they have no idea what they're doing. They see them as trading sardines. All they look at is price. They buy what junior they think is going to go up in the short term. They sell what junior is going to go down in the short term. No relation to price. No idea. I don't think most people do even know what news releases they are to be expecting in a company over the next 12 months. And of course, yeah, and the dumb crypto sector has helped exacerbate it for us even more. Literally this. I know the narrative is that, the crypto sector is punishing us, they're stealing all the money, and yada yada, there's no inflows, and that's all true. But again, you can think of it in a few different ways. Anything that's frustrating or irrational. you can either, again, complain about it, be taken advantage by it. If you view all juniors as pure trading sardines, you don't know what a good project is, you don't know why you bought something, you only thought that they were going to moonshot in a not too distant future, and they go down partially because of crypto. I can absolutely understand your frustration. If you, again, think more like, hey, actually, I know these cases well, I read up on them, I can see how much tangible value they have, how much tangible value they can create over the next, let's say, 1 to 5 years. And if I can buy that tangible value on the cheap and get all of that tangible potential for free, then you would be thanking the crypto space, because the competition is not here. That is why, if there was competition, if there was a lot of eyes on this, then you would see positive news releases get rewarded immediately. And you could not go back in time and buy them before the positive news is out and before the price went up. You have to pay for the fact that the fundamentals just improved for the company. If there's nobody in the sector, if nobody's watching, if nobody cares, if there's no new money, then you can see positive news releases that adds tangible long-term value, not have the companies go up in price. So you're de facto an insider. Because the whole idea of like insider buying, or it's like you buy on inside information, for example, what does that mean? I mean, why is it, I was going to say, frowned upon in a sense? It's because it assumes that if you know something positive is going to happen, something more material for the market, you know that while the market does not. You can buy it the day before it happens, then the positive news comes out, positive surprise. The price goes up, reflecting the changed fundamentals, the increased value of the company, and it gets repriced by the market. So you bought a company that's more valuable than anybody else knows, than the market knows. You bought it at a price that was not factoring that in. But in this sector, or any sector at depression level, depression sentiment levels, you can often see positive news get put out, and it creates a liquidity event instead, or there's just no action. So again, you can look at it in two ways. Either you can feel sorry for yourself, and yes, I know it's in a sense frustrating by the fact that if you held that stock, it means you were risking holding a stock that came out with negative news. So in a sense, at face value, in reality, given how depressed the market is, it's basically a heads I lose, tails I don't win anything. Because if the news would have been bad, you would see probably selling. But now the news was good, and you didn't get any reward for it immediately. So it's almost like a rigged game against the holder in a super depressed sentiment environment. Because if you take risk, you'll get overly punished for it if the risk appears. If it becomes a success, sometimes you won't get rewarded for it. So you're playing a game where you can only lose in a sense. But the trick is, that goes for a holder. For a buyer, it's the opposite. Because as a buyer, I can identify that the news made the company more valuable. And if the market does not reflect that, it means I'm buying even more for the same amount of money. The day before, I could have bought a stock worth $3 for $1. The day after the news, if there's no change in the price, I could buy a stock worth $4 for $1. I'm printing future money by the fact that the market is not pricing that in. Now me, as basically a chronic all-inner, since I'm basically fully invested at all times, I'm a holder in every story. So in a depressed sentiment, at face value, the bets don't look favorable, because you're kind of set up in a sense for the possibility of getting no reward for the risk you're taking. But A, you never know when the market will care. B, sometimes the stocks are so illiquid that you kind of have to get into them when you can, in a sense. I mean, meaning that if you think a stock is cheap, you have to just start buying, and it's like it's going to be volatile, but you can't be, you don't want to get in when everybody's rushing in an illiquid name, right? Because then you might pay up 50 to 100%, which I've seen recently in a junior that I've been looking at. But anyway, but the trick is that I'm also proactive, letting volatility and the depression, the depressed sentiment work in my favor, in the sense that while I'm being punished as a holder in case the market doesn't reward good news and doesn't reward risk taking that ended up favorably, I can also be a buyer, because I can sell something else, or if I get new money, and take advantage of the fact that the story got better. If I'm just a holder, not proactive at all, believe the BS by the market, refuse to buy any more of anything, especially if something positive gets put out and the market is not responding, I'm going to take that as well. I believe what Mr. Market is selling, and I'm not going to do anything about it. I might sell because I took risk, value of the company went up, price did not go up, so I'll conclude, well, this isn't working, so I'm going to sell just for the fact that I didn't get rewarded. I mean, that's not, obviously, you're not taking advantage of anything really. You just play that, somewhat rigged game, even though you never know if it's rigged. Then a favorable outcome happened when the company got up, increased in value, and the price stayed flat. It means it's even cheaper, and you sell out. I mean, that's even worse, because first you played a rigged game, and then when you could have taken advantage of the fact that the game was rigged for a holder, as you could have chosen to become a buyer, you become a seller instead. You're just constantly compounding the mistakes in that case. Yes, I know. I get in a sense at lows, you get punished as a holder a lot of time. Overreaction to the downside on negative news, low to no reaction on positive news. The thing is, if you constantly keep track of the value price gaps, even if your portfolio goes down, if you keep, let's say, appreciating the fact that news actually was positive, had the company go up in value, it's like even if your portfolio value is trending down in a sense, let's say you're down 30%, if you're aware of these increasing price to value gaps and the risking efforts, yada yada, and the lack of response for the market, while your portfolio might have gone down 30%, your future returns might be shooting through the roof, basically. So it's like your portfolio, before it went down 30%, might be looking at a 200% return, like $1 to $1,000 portfolio to $3,000 in the future. Now it's gone down 30%. It's down to $700, for example. But now, since you've been proactive and using the fact, using the volatility or non-volatility when there should be volatility, meaning that's like when a company should go up, have volatility to the upside, but it doesn't, you're abusing that. So now your portfolio is worth $700. So it's like at face value, you look like a complete moron. But you have spotted and reshuffled and thought about the price to value gaps. So now that portfolio that's only worth $700 might have cases with expected future returns of 500%. So you're actually you're gonna make even more money despite the fact that your portfolio is down 30%. Because you have more undervalued cases, much more undervalued cases in your $700 portfolio than you had in your $1,000 portfolio. But if you believe that the market is always right, and if you have paper losses, that must mean you're stupid and all of that, then you're obviously gonna, give up. You're probably gonna sell out. You're gonna sell the cases that actually became better and didn't go up, and sell the ones that didn't get any worse, but they went down in price. You're basically playing into the hands of Mr. Market. What he's kind of trying you to do, because he gets 95% of people to do that. So at all times, there's two ways. I mean, you can either be a victim or try to make Mr. Market a victim, the marginal investor. So again, volatility and non-volatility is both a curse and a blessing depending on what you do. I've shown this slide where I just showed that 3 people buy into a sector at the highs. It goes down 70%. The 3 people, one decides to sell. He makes that paper loss a permanent minus 70% loss. You have a holder who just holds on, doesn't do anything, and you have a buyer who adds when it's down 70%. When it goes up to the same price, or let's say a bit higher, the sector, the one who sold minus 70%, he's not on board anyway, so he took that loss and he's minus 70% because he cemented the paper loss. Probably went on buying another sector near the highs and gonna do the same thing, going from minus 70% to minus 70%. The holder, let's see, is even Steven or up a bit, but he then didn't really make any money. He wasn't proactive. He didn't take advantage of the lows. The one person of those 3, and all had the same market, same opportunities. The buyer who actually added even a bit at the lows, even if the sector goes up to the previous high, he's actually going to make money on it. Same market, same volatility, 3 different people, 3 different actions, 3 different decisions. That's the only difference. It's not the market. It's not the volatility per se. It's not like I'm immune to volatility. It's not like volatility doesn't happen to me. It's just that you can decide if you want to abuse it, see it as an opportunity, or if you see it as a victim, or become a victim. You get frustrated. You're not proactive, whatever. And I mean, anytime you sell cheap, you erode your long-term returns, except if you bought something even cheaper with the money. If you sell something worth $3 for $1 and it goes down to 90 cents, you will feel clever until it goes up to $3. That's basically it. I see a lot of people fretting about, now, the juniors are down today, and now it's, people are talking about, potential market crash that can have them go down more. That's the funny thing. I mean, some people were bullish 2 weeks ago, 1 week ago. Now when some of the juniors have gone down like 15% or maybe even more some cases, now they're starting to get bearish again. Why? Because the short-term trend is down. Now they're mostly worried about having even bigger paper losses. When the short-term trend was up a week or 2 weeks ago, they were bullish. They were probably putting money into the market. Now they're thinking if they should sell. How does that, I mean, where's this slide? I mean, this is a junior in one of the bull runs. I mean, if you look at and that's not even counting from the bottom. No one is going to hit the bottom. If you just take from this point here to up here, it went up 473%. That's a huge move. I think this was like 8 months. I think this might be in the 2016 rally. Look at all the corrections down the way. So if you're like everyone else, you're obviously putting in money here, selling out there because you fear the markets are going to crash or the sector is top. Or at least you fear that you're selling. Anybody that sells here sells because they think it's going to go lower. Anybody that buys here because they think it's going to go higher. How many people do you actually think even make any serious amount of money in any bull leg in this sector? Pretty much nobody. Because everybody's going to be trading away any types of returns. Everybody's buying high, selling low, buying high, selling low, buying high, selling low. Seriously, if you just banned yourself from buying any shares in this sector on green days, you might go from losing money to making quite a bit of money. I mean, imagine if you could only buy this junior on red days. You wouldn't be buying anything here. You would buy here, here, and here. You would buy on the way down. You'd buy on the way down. You would buy here, here, on the way down. You would buy this, short-term high, I guess. Buy some here, not buy here. Buy here, buy here, buy here. Not buy here, not buy here, not buy here. Buy here, buy there. Not buy here. You would just be riding the ups and buying the dips, basically, on average. Whereas like what most people obviously do is they buy only on green days and they sell on red days. Yeah, I mean, like, sneaky juror here. I don't have a single gainer so far today. Off to the beach I go. I mean, that's probably the most rational decision you can make. Unless you find something, I'm always, I like volatile days. I absolutely love volatile days. Preferably to the downside, because I have very hard time taking profits. I've said this a bunch of times. I'm very bad at selling. I'm really good at buying and holding. And if you think, I mean, that's what most people think. They think the reason they don't have any returns is because they're not good enough at timing short-term movements. Oh, that's absolute bullshit. Absolute bullshit. There's absolutely not the reason why you not catching every short-term move up or down, preempting it, selling every short-term top, buying every short-term low is not why people or you are not making any money. That is absolute bullshit. Pretty much nobody can do that. Nobody can predict that. I mean, nobody can predict the metal prices to any large degree. My way of going about it is like, that's why I keep saying about these hodl cases, where it's like, if you have an idea of a case, it's like, hey, I think this junior is worth this much. It's selling for this price, which is lower than what I think it's worth. And they have a long pipeline for growth or whatever. So it's like they have enough assets, projects, let's say, I mean, preferably they have money as well, that they can put out 50 news releases over the next 3 years. It's quite a bet if you're pretty goddamn sure that it's undervalued now, has maybe probable upside plus a large potential upside, that if you give the company 50 news releases to put out, that value could have changed a bit. The view of the company could have changed a bit. And in 3 years, if those 50 news releases are out, the market is going to be pricing it higher than today. I can find bets like that all over the place right now. I cannot find any single bet where I for sure know where the stock price is going to trade tomorrow, at the end of the day today, or next week, or next month. If you expand the time horizons, no-brainers become easier to spot. And I know what the big problem really is. It's that people are way too greedy. People are looking for the potential of getting 100% in a week or the next month. If you tell somebody, I know a case that's probably going to do 200% over 2 years, they wouldn't be interested. I mean, even when I read some cases where it's like, oh, they have this and that planned for the next 3 years. And it's like, oh, this mine is coming online in 2 to 3 years. You just roll your eyes. The idea of waiting 3 years is just way too much to bear. And that is where most of the opportunity actually is. That's why it's like, yeah, off to the beach I go. I mean, that is probably the perfect, I mean, that's why I post so much on Twitter and memes and stuff. I mean, it's kind of for my own benefit as well, because it at least keeps me busy from trying to do something too much with the portfolio, trying to force anything. And of course, like if you think buying that's one of those things as well. People who buy high, they think that's what's killing them. It's actually not. It's their inability to buy low. I buy high all the time. I mean, the thing with this sector is that since 2011, 80% of the time this sector has been in a bear market. So there's like 80% of the time it gets cheaper, 20% of the time it gets less cheap, typically very quickly. We haven't had that kind of exponential run really from the 2024 bottom. We have like spits and spurts or whatever you call it. But that's pretty good in the sense that we've had all the time in the world kind of to buy cheaper and cheaper and cheaper. And again, let volatility work in our favor, recognizing if a news release actually adds value. If the sentiment is so shit it doesn't revalue that project or company, we just found an opportunity. So there's been no shortage of opportunities, and the opportunities have typically become better and better and better. So I would say your portfolio should probably be much more undervalued today than 2 years ago, because stuff has gotten cheaper, and even some of the better cases have also become cheaper, despite the fact that gold is at record highs. Never seen anything like it. I mean, if you buy high, the worst you can lose is 100%. I mean, that goes for any point in time, obviously. If you sell cheap, you might lose out on 100%, 200%, 300%, 400%, 500%, 1,000% over the next 5 years. Selling, I mean, I've sold stuff for, it's like a company that I think is a 25 bagger now or something in like 2 years or something. The placement took too long to close, and I found something else to buy. I of course did not know it was going to go up 25 times. But that is a costly sell or non-buy. The most I can lose in any one stock is 100%. But I've lost out on stories or sold stories too early that went up hundreds of percent, 1,000%. Which goes back to my point about it's not buying high that's killing people. It's not buying high that kills your portfolio. It's people's reluctance to buy low, and buy low more the lower it goes. Because I'm a living example of that, because I buy highs all the time. I just buy more and more the cheaper it gets. Yeah, I mean, like I talked about before, I cannot overstate how much impact one day's worth of volatility can be for your long-term returns if you use it. Immense future money printing going on in juniors with legit asset. A 10% discount today might mean 40% in 2 years. And I remember, I mean, I used Patriot battery metals. I mean, that's kind of had a rocky road recently, of course, because basically the lithium price has crashed. But take this run up, because they actually found something of significance. This was a legit discovery. So this is how much to the top, 296% from the lows, and this was just, let's say, May. 2 weeks later, from this point, instead of 296, you would get 733. This is what I'm talking about. The volatility, the future. I mean, you couldn't possibly know how big it was going to get or anything like that. But you just know that, let's say nothing much changed here. I mean, take this example. From here, 500. From there, 987. Let's assume that this was just, a week's worth of volatility. I mean, I get chills just looking at a chart like this. Let's say this is an intact case. Geology didn't change, nothing changed, no news out, but just in 1 week from profit taking or traders or what have you, it went from 296 to 165. Let's assume nothing changed. When something gets that much cheaper, that much less is priced in. So in case of success, which happened to be, you get an additional 487% return from some idiot, let's say, or idiots selling it down for no reason in a few days worth of volatility. A 4-day move, irrational move, opened up a future extra 487%. Of course, nobody was thinking about that when they sold low. That's the thing. It's like an intact case with a potential intact growth story. If you can buy dips in that, your need for hit. I mean, this if you bought a few here compared to here, or it's like added down here, that extra 487% pays for a shit ton of other, let's say, high risk, high reward juniors that didn't do well. Just being able to buy low even in high risk, high reward situations means that your need for accuracy goes down. If you were good at buying dips in intact cases, you might get 50% average returns in your high risk portfolio if, let's say, 4 out of 20 cases work out. Whereas if you were unable to buy low, you only bought high, you might need to be right on, let's say, 7 out of 20 or something like that. Buying cheap means that you can suffer more losses. You need to be less often right, or I'm not going to say even right, because that what I talked about before, like in poker, I mean it's right to play aces, I mean pretty much all the time, but that doesn't mean you're going to win all of them. And in investing, you never actually know. I mean, you can't just look at the returns and say, well, I was that smart, because that's what everybody's doing in Bitcoin to, every high basically. If they're up, and 80% of the people who are invested in Bitcoin aren't even up in Bitcoin, which says something about, even if you take an all-time high asset, doesn't matter. Most people will have traded their gains away long ago. Going back to the, to the point where it's like even at a high here, I mean, the only people that really made any money were the hodlers and dip buyers. The short-term traders might have made some money, most won't really, because they're gonna be buying here, selling there, buying here, selling there, buying here, and then, yeah. So what was my point? Yes, buying cheap forgives a lot of mistakes in a sense. You can afford to make more mistakes the cheaper you buy. And again, if you have 20 intact stories where it's like you have a good idea what the next news releases could be in the next 12 months, you think it's cheap now. If that goes cheap, if those get, or 10 of them become 10% cheaper today, massive opportunity, absolutely massive opportunity. If they go get 30% cheaper, still intact story next week, even bigger. You might have one actually pan out, and it pays for 9 others. I mean, it's just immense how cheapness is both an offense and a defense. Yeah, and I mean some years, like some juniors, I mean I did some micro reshuffling, not big amounts, but I always want to feel if I see a stock that gets cheaper for no reason and cheaper than other stocks, if I even put $1,000 into that one that got more irrationally cheap than another one, I feel kind of good. So my micro trading, in a sense, is also a way for me to stay sane, because I always want to feel that I'm always abusing Mr. Market. if I see a volatile day and some stuff is down, 5 to 10%, that should really not be down, should be up 200%. If I can take advantage of that, I feel good. I feel like I'm punishing Mr. Market all the time. It's like it's just feeding me future money, feeding me future money. And even though a 0.001% reshuffling, even if I'm right and what I bought is going to return 20% more than what I sold, it's not going to amount to a huge amount, obviously, if you just have 0.001% reshuffling, but it feels good. And it's enforces, teaches me, or encourages this kind of thinking. I always want to feel like I'm stealing from Mr. Market. And again, it's like lots of big mistakes and lots of smart moves being done today at the same time. Somebody selling something that's down 10% for no reason and was already absolutely dirt cheap is making a long-term mistake, a huge long-term mistake. Anybody who's buying that is being very smart about it and might, get an extra 40% in 3 years. So I think any one of these days, again, and it goes back to reasoning. If I sell something down 10%, that should be up 200%. If I sell that and think I don't know, as a trader, short-term trader, whatever, it's like that's a mistake. If I'm selling something down 10% because I find stuff, and it's like every other store is down 20%, then I'm actually that's actually a smart sell in my situation, because I'm selling something that went from extremely cheap to 10% more cheap even, and buying something that was extremely cheap and got 20% cheaper. So I'm actually creating future money in that sense. But if you're selling what's down an irrational amount because I just think it's going to go down more tomorrow, from a value investor's perspective, or like a risk-adjusted value investor, or whatever you want to call it, that's obviously a gross mistake. You're just selling it because it's down. And let's say you're getting out of the sector, or you take that money and buy whatever else is up, for example. That's compounding a mistake. Yeah. And again, long term we get what we deserve in the markets. If you think you deserve good returns because you looked at one presentation, looked at one video, bought something because some promotional CEO said this is going to be the best thing since sliced bread. You just bought any kind of shitco, refused to be proactive, refused to take advantage of the volatility, refused to think that, there's no possibility that good news released, if it doesn't lead to a price increase, then it's not worth anything. I should be selling this junior. Instead of like, okay, the value actually went up. It's just Mr. Market being Mr. Market. It's like deaf, dumb, and blind, and I'm going to take advantage of it. Then you're earning your returns because you're thinking independently from Mr. Market. You're not swallowing the bullshit Mr. Market is putting out that, gold is down 1.3% on February 25. So it makes sense that the entire value of the company is 5% lower. I mean, that's ridiculous. That's just extremely ridiculous. And it's like something without value can never be cheap. That's why it's like, from a trading perspective, yes, even I, looking at, since I'm a sucker of buying low and buying panic and buying overreactions, even I am attracted to a dip like this. And obviously everybody's that been in Bitcoin has kind of been trained to be dip buyers, or hodlers have been trained not to sell because it's always gone higher. The thing is though that, I consider the intrinsic value of Bitcoin to be pretty much zero. So despite how low Bitcoin goes, I can never say it's cheap relative to an actual, let's say, gold project, where it's a robust project. The NPV today is 10 times what it's selling for. It has a high likelihood of getting built. It's an easy ore body, so it's gonna perform along with expectations. It's a high margin operation. That's as close to tangible values you can get in the junior space typically. That's actual value. That has meaning. Because that gold in the ground can get sold for cash, yada yada. You have a business there. There's no underlying business in Bitcoin. Yeah, I mean, just more of this. Yeah, and just, I mean, in tech stores that would do 300% over the next couple of years from yesterday's prices are sold today at prices where they will 330% instead. Yet it will be a big mystery why said sellers can never get a break and why it's impossible to make any money, even long term. Again, I don't see. It's like, what's the cardinal rule of a cyclical sector? It always crashes and always goes up. So like, just on that basis alone, you kind of know that the cardinal sin is to buy a sector, a cyclical sector, when it's depressed and cheap. If you knew nothing else, that would be like if you just heard and saw slides, like, what's a cyclical sector? Cyclicality means that it goes up and down. It's like, okay, what's the one thing I cannot do then? Sell low. Sell when it has gone down. But like, that's too much to ask. Because I'm seeing people throw in the towel now. And I mean, we're up since the 2024 lows, but we're not that up. And I don't give a shit about, like, oh, if the market goes down, it's going to take juniors with them. Yes, to what? An even more insane undervaluation? That happened in 2008. That happened in the flash crash of 2020. This was a flash crash. This was irrational selling. Gold didn't go down much. Some of these producers went down 50%. What happened then? I mean, you could have slept through this. The only thing this really hurt you, I mean, if you put in here, and it's like looking at that move, the only thing that would really hurt you if you bought here and sold on the way down. If you held here and, let's say, bought all the way down, and let's say, you know, some of these got overvalued up here. I mean, again, it's like you have three different investors. All three buy here. First go down. Let's say we'll stick it out. Goes up here. Then boom, in a short time frame, just, you know, a matter of weeks, goes straight down. Okay, three different investors. One sells out at the low. Here he believes, well, when it breaks this, he believes that it's gonna, whatever, go down here or something. So he sells low. So he takes a 45% loss in a few months. Okay, great. You cemented a paper loss. You sold when it was like the cheapest the sector might have ever been in the last 20 years. Congratulations. You sold low because you thought it was gonna go lower. You have the holder who sleeps through this, let's say. He wakes up a few months later and is like back up here. So he's actually made money. Shit ton more money than the guy who just lost 45%. Then we have the sensible, proactive, I'm not even going to say contrarian, because there's nothing contrarian about it really. You just see it's like, oh shit, I mean, stuff just got cheaper, I'm going to buy more. So he starts, whatever, buying here and buys all the way down. Buys more the lower it goes. When it's back up here, he's already would have a good amount of money. Then he can decide. I mean, let's say he also recognizes, well, these producers, I mean, they're not really that cheap anymore. So he might sell some or whatever. I mean, obviously he can identify that this is probably not a low. Yeah, okay, this doesn't go back to, I guess GDXJ wasn't around back then, but I mean, you kind of saw the same thing in the, excuse me, long day today. I mean, silver price, like, okay, well, this is it. Okay, flash crash, whatever, then this happened. flash crash, then this happens. So it's like, I mean, it's obviously, we're obviously not at a low in silver in that sense. But hey, I'm mostly I think silver is cheap. I mean, it's the only metal basically that's not past the 1980 highs. But I'm looking at like absolute cheapness. I can't tell you if gold is really cheap or if silver is really cheap. I would say silver is cheaper than gold, relatively speaking. What I do think is that some of these, especially gold uners, they're absurdly cheap. I don't feel like a contrarian for buying gold uners when their projects are what they have. Their assets are worth 10 times, up to 10 times. Let's say 5 to 10 times what they're selling for. That doesn't make me feel like a contrarian. I'm just actually looking at the obvious and just buying cheapness. Anyway, a long rant already. Hope you appreciate. I hope it became some copium. I mean, final thoughts. Don't take this sector seriously. I mean, I know it's like a quote I saw from a stock picker. He's more I think he's in the microcap club or something. I really like his stuff, but he made a tweet a while back saying that what was it? Sorry, I got a message. Saying that's like a big mistake that retail people do, or it's like retail investors that thinking that institutions are so much smarter than them, and that's a sobering thought. It's like you think that the market is always right. First of all, the junior sector right now is big. The only real trading typically in many names is pure retail. It's not even institutions because they're too illiquid. And even the institutions tend to buy high and sell low. That's just how it is. That's when they get money, when it's high and whatever. And they're forced to sell low, and maybe they're dumb enough to sell low even if they're not forced to. So I just assume that the market is absolutely batshit crazy. The market has no idea what it's doing. And I take bets on my conclusions. Because again, the best part about if you think you're buying cheap, if you're wrong, the worst thing that can happen is minus 100%. The most likely thing that might happen is more like minus 50%. If I'm right, if my case is this junior could go up 1,000% over the next 3 years, or a high risk, high reward explorer where it's like it's pricing in a 3% chance of success. I think it's 15%. If I'm right, even on average, I'm gonna make a shit ton of money. So it makes no sense to believe what the market is. I mean, then you're setting yourself up for failure, because if something looks absurdly cheap and you're paranoid about it, it's like, well, the market is always right. Are you going to take advantage of it? No. Because you believe the market is right. So when a stock is going up, you think the stock is getting better. Because that's what Mr. Market is suggesting. Oh, the stock is, the future of the company has been increasing for the last week. And then you just project that forward, etc. Anyway, yeah, so don't take this stuff personally. I mean, literally, you can just look at some swings in these juniors, like a day today, or a day where silver is down 1% and the gold juniors are down 5%, and you just say, it's like, oh my God, I mean, the market is just, I mean, it's just being stupid. It's just more stupid than yesterday. Basically, I mean, one would say that it's like, oh, that's arrogant, whatever. One second. Yeah, sorry, I had to answer a message. That's one thing. It's like in that sense, I'm arrogant. I believe the market is always wrong because it profits me thinking that way, in a sense. Because again, if I find an opportunity where I think, hey, this could go up 500%, if I don't believe that, if I don't act on it and thinking that the market is always right, I'm not going to take advantage of it, because the market is saying it's not going to go up 500%. you know. And worst case scenario, if one believes that, oh, the market is always right, then the worst case scenario is that I paid a fair price even if I'm wrong. You know what I mean? Anyway, hope that's enough copium. Market is closing in 10 minutes. I'm gonna see if there's anything, some micro trading to do maybe. Thanks for listening. Not investing advice, no buying or sell recommendation if I talked about any stocks. Consider me biased. I don't share your profits or your losses. I mean, you do what makes sense to you, etc. Thanks for listening. Bye.